Stop. Do not scroll past this video. I need you to stop whatever you are doing right now, because what is happening tonight in the silver market is something that most Americans will not understand until it is too late. Right now, while you're watching this, while the American markets are dark and Wall Street is sitting in their town cars heading home thinking they won today, the other side of the planet just woke up, and they are buying, massively, aggressively, with a hunger that should make every single person holding a paper dollar very, very uncomfortable. This is not a theory. This is not clickbait. The numbers are on the screen, and they are screaming something that the mainstream financial media absolutely does not want you to hear tonight. So before we go any further, if you are new here, hit that like button right now and subscribe to Silver Trends, because tonight's video is exactly the kind of content that the algorithm tries to bury. Every you drop keeps this information alive. Do it now. And then buckle up, because we are going deep. Now let me set the scene for you. It is Thursday night, March 19th, 2026. The New York Mercantile Exchange closed hours ago. The COMEX, which is the primary futures exchange where silver is traded in the United States, shut its doors. The algorithms are parked. The traders are gone. To the average American flipping through cable news channels right now, everything looks quiet. Silver is sitting at $76.38 on the spot price ticker, down from over $80 earlier this week. And if you are watching CNBC tonight, they will probably flash that number across the screen and tell you silver is pulling back, that the rally is cooling, that maybe you should rotate into something safer. That is the story they are selling tonight. But here's the story they are not telling you. At this exact moment, 9 in the morning on Friday, March 20th in Beijing, the Shanghai Gold Exchange has just opened for their Friday trading session. The sun is coming up over the People's Bank of China, and every institutional buyer, every sovereign wealth fund, every industrial manufacturer in the Eastern Hemisphere is staring at that $76 number, and they are not scared. They are not selling. They are loading up. Because what Wall Street is calling a price correction, the East is calling the greatest discount window they have seen since the COVID crash of 2020. Now, to understand why tonight is so critical, you need to understand the difference between the two silver markets that currently exist on this planet. And this difference is everything. This difference is the entire story. The COMEX in New York is what we call a paper market. The vast majority of silver contracts that trade on the COMEX never result in anyone actually taking delivery of physical silver. They settle in cash. They are digital agreements, numbers on a screen, promises made between traders who have no intention of ever touching a real bar of metal. The COMEX is, at its core, a price discovery mechanism. But here's the problem. When you divorce price discovery from physical reality, when the number on the screen has nothing to do with the actual supply of real metal in the real world, you create a system that can be manipulated. A system where a handful of large institutions can flood the market with paper contracts, drive the price down, scare retail investors into selling, and then scoop up the discount. That is what happened today. That is the $76 number. Now compare that to the Shanghai Gold Exchange, the SGE. The SGE is not a paper market. When a Chinese entity buys silver on the Shanghai Gold Exchange, they are buying real silver, physical bars. Metal that gets pulled from a vault, loaded onto a truck, put on a plane or cargo ship, and delivered to someone who actually wants to hold it. The Shanghai market demands physical delivery. And that distinction, that single fundamental difference, is why everything that happens in Shanghai overnight has the power to completely blow up what the COMEX is trying to do during the day. Because you can print paper contracts all you want. You cannot print silver bars. And here's where tonight gets genuinely alarming. The COMEX just reported that registered silver inventory. And this is the specific category of silver that is actually available for delivery against futures contracts. Not total silver, not silver in transit, but silver with a warrant attached to it sitting in a vault ready to be handed over. That number has fallen below 90 million ounces. Let me say that again clearly so it really lands. Registered silver on the COMEX has dropped below 90 million ounces. That is a 31% decline in just 5 months, from October of 2025 to right now in March of 2026. 31% gone in 5 months. Now some context. During the 2008 financial crisis, one of the most severe economic disruptions in modern history, COMEX silver inventory dipped about 15% over 12 months. That 15% drop over a full year was considered dramatic. It spooked analysts. It contributed to silver eventually running from $9 to nearly $50 by 2011. We just did 31% in 5 months. We are in completely uncharted territory here. And when you run the coverage ratio, which is the percentage of outstanding paper claims that could actually be satisfied with the physical silver sitting in those vaults, you get a number that should make anyone who understands markets very uncomfortable. The coverage ratio right now is sitting at 13.7%. 13.7. What does that mean in plain English? It means that for every 100 ounces of silver that has been promised on paper through futures contracts, options, and ETF shares, there are only 13.7 ounces actually sitting in a vault ready for delivery. The historical average for this ratio hovers around 20 to 25%. Below 15% is considered crisis territory. We are at 13.7 and falling. And the paper leverage ratio, which shows you how many paper ounces exist for every real physical ounce in the registered category, is sitting at 7.3 to 1, 7 paper ounces for every 1 real ounce. That is not a sustainable market structure. That is a pressure cooker with a stuck valve. Let me do the math live so you can see exactly what this means in dollar terms, because numbers without context are just numbers. Take 90 million ounces, multiply it by today's spot price of $76.38. That gives you approximately $6.87 billion. $6.87 billion. That is the total notional value of all deliverable registered silver on the COMEX, the exchange that backs the most important silver futures market on the entire planet. $6.87 billion. For comparison, Apple Computer has more cash sitting in their corporate treasury right now than the entire deliverable silver market on the COMEX. The entire system that underpins global silver price discovery is backed by less metal than what a single technology company keeps in a checking account. That is the absurdity. That is the fragility of what we are dealing with. Now here is where March specifically matters, and why tonight, right now, is such a critical moment in time. March is a major delivery month on the COMEX. The open interest for March silver, meaning the active contracts that are outstanding right now, represents approximately 500 million ounces notional. 500 million ounces of paper silver claims, and the registered inventory available for physical delivery is under 90 million ounces. 500 million in claims, 90 million in real metal. Now, I want to give you the historical pattern here, because this is not the first time we have seen physical silver markets get squeezed. And every single time it has happened, the outcome has been the same. In 1979 and 1980, the Hunt brothers, Nelson and William Herbert Hunt, 2 Texas billionaires, cornered the silver market by buying 100 million ounces and demanding delivery. Just 100 million ounces broke the COMEX. It forced the exchange to change its rules mid-game. It caused silver to spike from $6 to nearly $50 in a matter of months. 100 million ounces from 2 private individuals shook the entire system. Today, we have sovereign nations, central banks, the People's Bank of China, the Reserve Bank of India, entities with balance sheets that make the Hunt brothers look like they were working with pocket change, draining more than that in a single quarter. Think about that for a second. The scale of what is happening right now dwarfs every previous episode of physical silver tightness in recorded commodity market history. In 2008, silver crashed hard when Lehman Brothers collapsed and everything got liquidated. Silver hit $8.60, but within 18 months, it had quintupled to over $49. The crash was not the end. The crash was the spring being compressed before the release. And in 2020, during the COVID pandemic, when silver hit $12 and the Perth Mint ran out of inventory and the U.S. Mint suspended Silver Eagle production, and APMEX had delivery waits stretching 4 to 6 weeks. Silver went from $12 to over $30 in less than a year, 150% gain. And both of those times, the physical divergence from paper was the signal. The premium between what dealers were actually charging for a real silver coin versus what the COMEX said silver was worth, that spread was the market telling you the truth. And right now, that same spread is wider than it has ever been. The COMEX says silver is $76, but the actual retail price of a physical Silver Eagle, a real 1-ounce coin you can hold in your hand, is running anywhere from $84 to $96 depending on the dealer. The physical market has already repriced. The paper market just has not caught up yet. And that gap closes. It always closes. The question is never if. The question is when and how violently. Let me explain exactly how the metal is flowing right now, because this is the mechanical engine running in the background while most people sleep. When the Shanghai premium is elevated, meaning silver costs more to buy physically in China than what the COMEX price suggests, traders have a direct financial incentive to buy paper silver on the COMEX, stand for delivery, take actual bars out of the COMEX vault, ship them to Shanghai, and sell them at the higher price. That spread is pure profit. So what happens? Metal flows east, the COMEX vault gets lighter, the registered inventory drops, the coverage ratio shrinks. And because the paper price on the COMEX is being held down by these same institutions with massive short positions, the Shanghai premium widens further, which means more metal flows east, which depletes the vault faster. It is a self-reinforcing loop, a cycle that feeds itself. And it does not stop until either the paper price dramatically rises to close the gap with the physical price, or the COMEX runs out of metal to deliver. Now, earlier in 2026, the Shanghai premium was running 5 to 15% above COMEX spot prices. When registered inventory dropped below 100 million ounces back in February, reports showed the premium spike to $10 an ounce above Western spot. $10. The same bar of silver, same purity, same weight, same elemental composition, was simultaneously worth $10 more per ounce in Shanghai than in New York. That is not a temporary market anomaly. That is a structural divergence between two separate pricing systems for the same physical commodity. And the one that demands real delivery, the one where you cannot just send someone a check and call it square, that market is pricing significantly higher. That tells you which price reflects reality and which price is the manufactured illusion. Now let me bring in the big picture, because this is not just a commodity story. This is geopolitical architecture. This is the financial operating system of the 21st century being rewritten in real time. While most Americans are watching reality television, the United States national debt just crossed $36 trillion. The annual interest payment on that debt now exceeds $1 trillion per year, more than the defense budget, more than Medicare, more than Social Security. The United States government is paying more money every single year just to service what it already owes than it spends on defending the country. That is the fiscal backdrop against which all of this is happening. And while that is going on, the BRICS nations, Brazil, Russia, India, China, South Africa, and now a growing list of additional members, including Saudi Arabia, UAE, Egypt, and others, have been systematically building an alternative financial architecture designed to reduce dependence on the US dollar and the Western-controlled SWIFT payment system. They launched an alternative settlement mechanism in 2024 and have been expanding it throughout 2025 and 2026. They are conducting bilateral trade in local currencies, backed not by the promise of any single government, but by hard assets, physical gold, physical silver, real commodities with intrinsic value. The People's Bank of China has been accumulating gold at a pace exceeding 200 metric tons per year. The Reserve Bank of India has been buying gold and silver at record levels. Russian central bank reserves have been systematically shifted away from dollar-denominated assets toward physical gold since 2018. This is not conspiracy. This is on the public record. This is a coordinated, systematic de-dollarization strategy conducted at the sovereign level. And silver, because it sits at the intersection of both monetary metal and critical industrial metal, essential for solar panels, electric vehicles, 5G infrastructure, medical devices, circuit boards, and virtually every advanced technology product, silver is at the absolute epicenter of this strategic shift. The inflation picture is making all of this more urgent. The Producer Price Index, which measures wholesale inflation at the manufacturing level, is running at a 3.7% annualized rate right now. 3.7. That is not transitory. That is not cooling. When producer prices run that hot, consumer prices follow, and when the CPI comes in elevated, the Federal Reserve is trapped in one of the most difficult policy positions in modern central banking history. They cannot raise interest rates meaningfully because the national debt interest payments would become explosive. We are already at $1 trillion a year, and every rate hike makes that worse. But they cannot cut rates either because inflation is still running above target. They are pinned. They are stuck in a corner with no clean exit. And every institutional money manager in the Eastern Hemisphere fully understands this constraint. They see the trap. And they see physical silver as the cleanest exit from a dollar-denominated system that has structural problems baked in at the foundation. Now, let me walk you through what the COMEX open interest data and the QOT report are telling us, because this is the last piece of the puzzle. The Commitment of Traders report, published by the CFTC every Friday, shows the positioning of different categories of market participants in the silver futures market. And the latest data shows that commercial entities, which is Wall Street's polite way of describing the large bullion banks, are holding their largest concentrated short position in silver futures since October of 2025. Let me let that sink in. Right now, at the exact moment when physical silver supply is at its tightest in modern history, when the vaults are draining at unprecedented speed, when the Shanghai premium is elevated, when industrial and sovereign demand is running at record levels, the bullion banks have chosen to double down on their short positions. They are betting very aggressively that the price does not go up. Now let me tell you what happened every other time they made that same bet in a tightening market. When they doubled down on silver shorts in October of 2010, silver ran from $25 to nearly $50 in 6 months. When they doubled down in March of 2020, silver ran from $12 to $30 in 5 months. When they doubled down in late 2024, silver ran from $32 to over $80 through 2025. Every single time the banks extend their concentrated short position into a market where physical supply is getting tighter, the snapback is violent. And the physical market has never been this tight. Not in 2010, not in 2020, not ever. The spring has never been compressed this far. And here's the scenario that I believe is being set up for tomorrow morning. Right now, overnight, while New York sleeps, the Shanghai session is actively buying physical metal. Chinese industrial buyers who need silver paste for solar photovoltaic cells. Electronics manufacturers who need silver for circuit boards. Sovereign wealth funds diversifying away from U.S. Treasury bonds. Indian jewelers preparing for the spring wedding season. Indian banks accumulating silver ETFs at record pace. They are all looking at the $76 COMEX number, and they are placing buy orders for physical metal. They are not buying paper contracts. They are demanding real delivery. They are draining the Western vault through the arbitrage mechanism I described earlier. And when the Friday morning bell rings at 9:30 a.m. Eastern Time and the New York traders log into their terminals, they are going to see something in the overnight data that will stop them cold. They are going to see that the physical inventory they were planning to use to cover their short positions has been allocated. It is gone. It is loaded onto cargo ships heading east. And nobody wants to carry a massive naked short position in silver into a weekend when the Middle East is in active escalation, when producer price inflation is running hot, and when the COMEX vaults are at historic lows. That is the setup for a Friday morning liquidity cascade. That is the setup for what analysts are now calling a V-shock, a sudden violent price reversal driven by short covering algorithms, all trying to exit at the same time. When those algorithms flip from suppressing the price to desperately chasing the price, and they are operating in a market with a 13.7% coverage ratio and sub 90 million ounces of registered inventory, there is no natural ceiling. The price goes wherever the physical market says it should go. Now, I want to be completely honest with you, because that is what Silver Trends is built on. I could be wrong about the timing. These events do not always happen exactly when the data suggests they should. The banks have resources and tools to delay the reckoning. They have done it before. They will try to do it again. But here's what I am confident about. The math does not lie. The inventory is draining. The coverage ratio is at crisis levels. The physical premium over paper is widening. The Eastern sovereign accumulation is accelerating. And the commercial short position is at levels that have historically preceded violent price corrections to the upside. Every single fundamental indicator is pointing in the same direction at the same time. The convergence of these factors in a single moment, right here in March of 2026, is what makes this particular period so significant. This is not one signal. This is every signal firing simultaneously. If you are someone who has been watching the silver space for a while, you already understand most of this. But if you are newer to this, if you stumbled across Silver Trends tonight, and this is the first time you're hearing about the paper physical divergence, the COMEX coverage ratio, the Shanghai premium, the rehypothecation problem, I want you to do one thing. Do your own research. Start with the COMEX's own publicly reported inventory data. Start with the CFTC's commitment of traders reports. Start with the SGE's published premium data. The information is out there. It is public. You do not have to take my word for anything I said tonight. The numbers speak for themselves. But I promise you, when you start pulling on this thread, when you start looking at the actual supply and demand fundamentals of the physical silver market alongside the paper leverage being applied on top of it, the picture that emerges is not subtle. It is glaring. The physical price of silver, the real price, the price you would pay to actually hold an ounce in your hand, has already decoupled from the COMEX number. The decoupling is not going to close by the physical price coming down to match the paper price. That is not how this resolves. Physical supply does not magically appear because someone prints more paper contracts. The resolution happens the other direction. The paper price has to rise to meet the physical price. And when it does, when the algorithms are forced to cover, when the gamma flip triggers, when the liquidity cascade begins, the move is not going to be gradual. It is not going to give you time to think about it over a cup of coffee on a Sunday morning. When the COMEX price and the physical price reconcile violently, the window to be positioned correctly will be very small. History has shown that repeatedly. In 1980, in 2011, in 2020, in 2025, every significant silver price event moved fast. Faster than most retail investors could react. I'm going to be at the terminal tonight. I have the SGE data feed running. I have the COMEX after hours data on another screen. I'm watching the Globex overnight session for any unusual activity in silver futures. And I will be here when the Friday morning session opens in New York. Make sure you are subscribed to Silver Trends with the bell notification turned on and set to all notifications. Because if this thing moves tomorrow morning, you need to know in real time. Not when Bloomberg runs a segment calling it unusual volatility 3 hours after the fact. Not when CNBC gets around to mentioning it during their afternoon programming. You need the alert the moment it happens. Subscribe and hit that bell right now if you're not already. I want to leave you with this thought because I think it matters beyond the trading mechanics, beyond the leverage ratios, beyond the vault inventories and the premium data. We are living through a period of genuine monetary transition. The architecture of global finance that was built in the post-World War II era centered on the US dollar as the world's reserve currency, backstopped by the full faith and credit of the United States government. That architecture is under more structural stress right now than at any point in the past 70 years. The $36 trillion debt, the $1 trillion annual interest payment, the de-dollarization efforts of the BRICS coalition, the shift toward physical assets and central bank reserves globally. These are not temporary trends. These are directional, structural, multi-year shifts in how the world stores and transfers value. And in every previous monetary transition in history, every single one, physical precious metals have served as the bridge, as the store of value that survives the transition intact, while paper promises on the wrong side of the change get devalued. Silver right now is sitting at the intersection of all of these forces. Industrial demand from the green energy transition that is only going to accelerate. Monetary demand from central banks and sovereign wealth funds around the world. A structural supply deficit that has been building for years, and a paper market that is leveraged to a degree that makes the entire system vulnerable to a single sustained push for physical delivery. The East is making that push right now, tonight, while you watch this video. And the Vault drawdown data says they have been making it for months and months before tonight. Silver Trends has been covering this story because it is the most important financial story that the mainstream media is systematically ignoring. And I am going to keep covering it because the data keeps pointing in the same direction. Before you close this video, I want to ask you something directly. Drop a comment below right now. Tell me where you are in this. Are you holding physical silver through tonight's paper price action? Are you sitting in cash, watching the $76 number and trying to decide what to do? Are you new to the space and trying to figure out if any of this is real? Whatever your situation, drop it in the comments. I read them. I respond. And the community that has built up around Silver Trends is one of the most informed, engaged groups of people tracking this market anywhere online. Your comment also does something important for the channel. It tells the algorithm that real people want real information. It helps break the suppression that buries content like this. So leave a comment, share this video with someone you think needs to see it tonight, because the information in this video could genuinely change how someone approaches the next few weeks. Share it right now before you forget. A single share from you reaches people who would never find this channel on their own. And in a market that moves as fast as silver can move, having the information even a few hours earlier than the mainstream narrative catches up can make all the difference. This is Silver Trends. The Asian markets are open, the vaults are draining, the paper price is not the whole story, and the real market is telling you exactly where this is headed.